All right, here we're going to show you how to bank on your fix and flips utilizing the infinite banking concept. All right, so as we dive into these numbers, again, I stress don't get caught up on the number of zeros. Let's just look at how the policy works, what it's doing, how it's growing, and so forth. If these numbers are too many zeros for you, take off a zero. Let's look at it. Functionally, it's the same. If it's not enough, add a zero, and functionally, it's the same. All right, so we just want to understand the principles behind it. So this client, when we got into it, decided to start funding his policy at $25,000 a year. So he's going to fund his policy at $25,000 a year, and then he's going to be utilizing the cash value to make him money or save him money. So here's your premiums over here, $25,000, also right here, next to this big red arrow. This is premiums year over year over year, and then where this big red box is, that's his cumulative cash value that particular year. So in this case, you can see by year 3, he's got about 68,000 and change in there. By year 5, he's got 120 and change. He's got 200,000 by year 8, and so forth. It's going to continue compounding year over year over year. So we want to start utilizing this for fix and flips in this example and how we could turbocharge our existing strategy. So here's a breakdown of a scenario. Okay, if this deal was a $250,000 purchase with a $35,000 rehab and $350 ARV. It was estimated to be about a 3-month hold and typical holding costs. All right. So utilizing hard money and private money, which is pretty standard. Then we're going to do hard money at about 10 and 4, private money at 10 and 2. I'm sorry, 12 and 4, 10 and 2. And net profit after all said and done, 3 months was 19.8. So that's his taxable burden, if you will. So that's okay, modest little fix and flip, all right? But then we want to look at what if we used that cash value to replace some of the hard money or private money lending? What does that do for us? Now, if you haven't watched a previous video on how the infinite banking concept works and is generally structured in the PUA and base premium, I encourage you to go back and watch that first and then dive right back into this. But anyway, so the premium, he's going to actually borrow the cash value of $55,000 himself. He's going to borrow against his own policy. So you see that reflected over here. He's still going to use hard money, 12 and 4. And then private money would be himself. Okay. He'll borrow against his own policy and at a 5% cost. Now, here, hard money and private money, he's going to make $21,593. Mostly because we saved on the interest, right? The previous number, if you recall, was 19 and change. So we jumped up a little bit, mostly because of the interest savings. But inside of your policy, the cash value is growing uninterrupted year over year. So that particular year that he had this money, cash value also grew $3,656. It's net cash value growth. Okay, so he did the 21.5 plus an additional $36.56 in here. Now, a lot of people say, well, cash is king. I can pay cash and make a lot more money. Well, that's true. Because previously he made $21,005, but if you paid cash, now you see at the bottom here, he's up to $39,000 and change. Here, $39,000 and change. It's quite a bit more. This is your taxable burden, though. So you have lost opportunity costs, which you have to consider, plus your taxable burden, which you have to consider. So your profit was $39,700. But then we ask the question, what happens if we borrow that same amount against our policy instead of just paying cash for it? Well, if we borrow against our policy over here, you see the numbers. See the net profit actually dropped to 35 and change down here. 35 and change versus the 39 and change. Plus cash value growth that particular year, 36.56. So our true profit was still 39 and change. Why would we do this? Go through all this. Well, this down here is our taxable burden, not this. Right? 39 and change is our true profit, but our taxable burden has been reduced because we have this interest cost here. We are not paying taxes on the gain inside of our policy either, because we will always access them as policy loans, and the IRS does not tax on loans. So we've reduced our taxable burden. Plus, it's an unstructured loan. We borrow against our policy, and we get to dictate the loan terms. If you're doing a fix and flip, how many of you have opened up that wall and whatever was behind that wall just tacked on a month or two to your deal? And you know who doesn't care is the lender. They still want to get paid. You can't say, I need to pause the payments so that I can handle ... If you're borrowing it from yourself, you can tell yourself, I need more time to pay myself back. And I'm sure you will be agreeable with yourself. You understand? You are your own banker. It's an unstructured loan. The insurance carrier is not asking for the money back. Why? Because they have collateralized your death benefit, so they don't care when you pay it back. They know you're good for it via the death benefit. Okay? Plus, there's things you can do like deduct the interest for business expenses, and you have the uninterrupted growth component inside of your policy throughout your life. So here's what that policy looks like in graph form. Okay? So you see the yellow line, the cumulative premium, and the purple is his cumulative cash value. On average, the way we structure these, somewhere between years 2 and 4, the cash value begins growing more than premiums. So in his case, from year 3 to 4, you see that reflected. You actually see that from year 2 to 3. From year 2 to 3, he put 25 in, and cash value started growing a little bit more than 25. And then that number, that spread, that growth, gets larger every single year. On average, the way we structure these, somewhere between years 6 to 10, the cumulative cash value exceeds the cumulative outlay. In other words, it's caught up for the first couple of years, loss of access. And then you're off to the races. And this spread gets larger and larger and larger throughout your entire life. You see, this person, by the time he's 70, he will have only put $560,000 in premiums throughout his entire life. And he will have $1.7 million in cash value sitting there. That's a $1.1, almost $1.2 million gain that is not taxable because the IRS does not tax on policy loans. It stays inside your policy. And we haven't even talked about the death benefit. That's this top number. That's above and beyond that. That's not above and beyond, but it's an additional bonus to what you're doing. So let's say you get to age 70 and you borrowed the full 1.7 million out and were to pass away the next day. They'll simply reduce the 1.7 from the $3 million death benefit and pay the difference to the beneficiary. So that's what I said earlier. They're collateralizing your death benefit. That's why they don't care when you pay it back or if you pay it back. Now, you want to be an honest banker. You want to have a plan to pay yourself back because you always want to repurpose that money and use it later. Use it again. Use it for legacy at the end. Now, we can use this for retirement. We'll have another bit on that on a different video.